Question 1. Are you ready? Picture this. Your client has a huge chunk of their portfolio in just one stock. The stock market's going wild, up one day, down the next. Your client asks you, should I sell some of this stock to diversify or hold on to it? Now think of it this way. Selling some stock and diversifying means spreading the risk. It's like having multiple safety nets. If one stock drops, others might hold steady, protecting your client. But if they keep everything in one place, they're putting all their eggs in one basket. Holding on to that single stock could be risky, because if it tumbles, they're fully exposed. So, selling and diversifying might be the smarter, safer move, reducing risk and providing balance. Question 2. Are you ready? Let's imagine this scenario. The Federal Reserve just announced an interest rate hike and your client is asking if they should buy more tech stocks. Sounds exciting, right? But here's the thing. Tech companies often rely on borrowing money to grow. When interest rates go up, borrowing gets more expensive, which can slow down their growth. So if your client buys tech stocks now, it's like sailing against the wind. It's much harder for those companies to grow. But if they wait for the market to stabilize, they reduce their risk and might get a better entry point later. Waiting might just be the better option here. Less risk, more time to see where the market's going. Question 3. Are you ready? Imagine your client is getting closer to retirement and most of their portfolio is still in growth stocks. They ask, should I shift to bonds or stick with stocks? Here's the deal. As people near retirement, they often look for stability, and that's what bonds provide. They offer lower risk and steady income, perfect for someone who doesn't want to ride the ups and downs of the stock market anymore. If your client stays heavily invested in stocks, especially growth stocks, it could be too risky. Stocks can be volatile, and if the market crashes, they might not have enough time to recover before retirement. Shifting to bonds could provide that stability and peace of mind as they approach retirement. Question 4. Are you ready? Let's say a company's stock just dropped 10% because it missed its earnings expectations. The fundamentals are still strong, but your client wonders, should I buy now or wait? Think of it like this. The stock's price is down, but the company is still in good shape. Buying now might be a great opportunity to grab it at a discount. It's like getting a good deal on something that's still valuable. But waiting for the stock to drop further could be risky. You might miss the opportunity if the stock rebounds quickly. Sometimes, buying during a dip, when the fundamentals are strong, can be a smart move. Question 5. Investing in high-volatility small-cap stocks. Are you ready? Your client is considering investing in a small-cap stock with high growth potential, but also high volatility. They ask, should I go for it? Here's the thing. Small-cap stocks can offer huge rewards because they have room to grow. But they're also like a roller coaster, full of ups and downs. If your client is okay with that kind of thrill ride, it could be worth the risk. But if they want something safer, they might want to stay cautious and avoid the wild swings small-cap stocks are known for. Question 6. Buying at market highs. Are you ready? Here's a classic situation. The stock market is hitting new highs and your client asks, should I buy an index fund now or wait for a correction? It's tempting to jump in when everything is going up, but buying at a market high can be risky. It's like joining a party when everyone's already been there for hours. The fun might end soon and you could miss out. Waiting for a correction, when prices come down a bit, might give your client a better opportunity to buy in at a lower price. Question 7. Holding cash or investing. Are you ready? Your client is sitting on a pile of cash and asks, should I invest this money now or hold on to it? Holding cash feels safe, but it's also like keeping money under your mattress. It doesn't grow. If your client invests that cash wisely in a diversified portfolio, they might see returns over time. But holding on to cash means they could miss out on opportunities to grow their wealth. So investing now, especially in a diversified way, might be a good move to make that cash work for them. Question 8. Biotech stocks awaiting FDA approval. Are you ready? Your client is excited about a biotech company with a promising new drug, but the drug is still awaiting FDA approval. They ask, should I invest? It's risky. Biotech stocks can soar if a drug gets approved, but if it doesn't, the stock can crash. It's like betting on a coin toss. Waiting until after the FDA decision might reduce that risk and provide more certainty. So, while the rewards could be high, it's smart to consider the significant risk involved. Question 9. Emerging market ETFs, are you ready? Your client is thinking about investing in an emerging market ETF. They've heard about the potential for high returns, but are also worried about the risks. What do you recommend? Emerging markets can offer huge growth potential, but they're also known for volatility. It's like sailing in stormy seas. There could be calm after the storm, but the ride there can be rough. If your client proceeds, they should be cautious and prepared for the ups and downs. But if they want something steadier, they might want to wait until things settle down. Question 10. Takeover rumors, are you ready? Your client holds stock in a company rumored to be a takeover target, and the stock price is rising. They ask, should I sell now or hold on? Takeovers can send stock prices soaring, but rumors don't always come true. Selling now lets your client lock in gains and avoid the uncertainty if the takeover doesn't happen. It's like cashing out your winnings at a casino. You've already won, so why risk it? Holding on might lead to more gains, but it's a gamble that could backfire if the rumor turns out to be false. Question 11. Dividend stocks and a slowing economy. Are you ready? Your client's portfolio is packed with dividend-paying stocks, but now the economy is showing signs of slowing down. They ask, should I rebalance towards growth stocks? Think about it this way. Dividend stocks are like a steady paycheck. When times get tough, these stocks tend to hold their value and keep paying out. Growth stocks, on the other hand, are riskier, especially in a slowing economy. They rely on fast-paced growth, which might slow down too. So, sticking with dividend stocks might be the safer, smarter choice right now. They can provide stability when the economy is rocky, while growth stocks might struggle to perform. Question 12. Investing during inflation. Are you ready? Inflation is rising, and your client wants to know, should I invest in stocks, commodities, or hold cash? Here's how to break it down. When inflation hits, holding onto cash might seem safe, but cash loses value over time as prices rise. It's like watching your money slowly melt away. Investing in stocks can offer some protection, but they might not always keep up with inflation. Now, commodities, things like gold or oil, often rise in value during inflation. It's like having a safety net that gets stronger when prices go up. So, suggesting commodities might be a good way to hedge against inflation, giving your client a better shot at maintaining their buying power. Question 13. Growth stocks versus dividend stocks. Are you ready? Your client is debating. Should I invest in growth stocks, which are volatile, or stick with safer, dividend-paying stocks? It's a bit like choosing between a fast car and a reliable old sedan. Growth stocks can zoom up, but they're unpredictable. They can crash just as quickly. Dividend stocks are more like that dependable sedan. They don't move as fast, but they keep giving back steady returns in the form of dividends. If your client values stability and income, dividend stocks might be the safer option. Growth stocks can bring higher returns, but they're riskier, especially if your client can't afford a bumpy ride. Question 14. Investing in commodities, are you ready? Your client is excited about commodities like gold or oil, but also nervous about their volatility. They ask, should I invest in commodities? Here's what you can tell them. Commodities are like wild horses. There's potential for great rewards, but they can be tough to control. Prices can swing widely, and that volatility might not be suitable for everyone, especially if your client wants stability. Unless your client has the experience and risk tolerance to handle those swings, it might be better to steer clear of commodities for now. Question 15. Cryptocurrency for diversification. Are you ready? Your client is thinking about dipping a toe into cryptocurrency for diversification and asks, should I go ahead? Cryptocurrency is the wild west of investing. Extreme highs, extreme lows. It's like trying to ride a bucking bronco. Sure, some investors have made big profits, but many have lost just as much in a flash. If your client is okay with potentially losing a significant part of their investment, they can proceed with caution. But for most investors, the high risk makes it a gamble that might not pay off. Question 16. Rebalancing to bonds nearing retirement. Are you ready? Your client is 10 years away from retirement and heavily invested in stocks. They ask, Should I rebalance towards bonds? Think of it like this. As your client nears retirement, they need more security and less risk. Stocks can still grow, but they can also drop suddenly. Bonds, however, are like the sturdy bricks in a house, reliable, predictable, and less likely to lose value quickly. Rebalancing towards bonds provides stability and ensures that your client's wealth is protected as they get closer to retirement. Question 17. Investing in IPOs, are you ready? A new IPO is about to launch and your client asks, should I invest immediately or wait for the stock to stabilize? IPOs can be exciting, but they're also unpredictable. It's like stepping onto a roller coaster without knowing how steep the first drop is going to be. Early investors might make big profits, but they could also face major losses if the stock crashes. Waiting until the stock stabilizes gives your client more information and a chance to assess whether the company is truly worth investing in. It's the safer option. Question 18. Margin call, are you ready? Your client receives a margin call and asks, should I sell some assets to meet the call or add more funds? When a margin call hits, it's a sign that things are getting risky. Selling assets to meet the call is like trimming the sails during a storm, reducing risk and keeping things under control. Adding more funds, on the other hand, is like doubling down and exposing your client to even more risk. In most cases, it's safer to sell some assets and reduce the margin exposure rather than pouring in more money and increasing debt. Question 19. Margin trading, are you ready? Your client is tempted to use leverage and trade stocks through margin. They ask, what do you think? Margin trading is like borrowing money to gamble at a casino. Sure, if things go well, your client might win big. But if the market goes against them, they could end up owing more than they can afford. It's a risky strategy that's best left to experienced traders. For most investors, it's smarter to avoid margin trading and stick to investments they can afford without borrowing. Question 20. Dividend reinvestment plan, also known as DRIP. Are you ready? Your client is considering a dividend reinvestment plan and asks, should I go for it? A DRIP is like planting seeds. Each dividend gets reinvested to buy more shares, and over time, those shares grow and multiply. It's a powerful way to compound wealth without much effort. Unless your client needs the cash from dividends right now, a DRIP is usually a smart choice. It allows their investments to grow without the temptation to spend the cash dividends. Question 21. Hedge funds. Are you ready? Your client is interested in hedge funds because they've heard about the high returns, but they're also worried about the risks. What should they do? Hedge funds can be like a high-stakes poker game, huge wins, but also the potential for huge losses. They're complex and often use risky strategies that aren't always transparent. For most clients, it's better to stick to more transparent, less risky investments, especially if they're not comfortable with the wild swings that hedge funds can bring. Question 22. Real estate market timing. Are you ready? Your client is considering investing in real estate but is unsure if the timing is right. They ask, should I invest now or wait? Real estate markets can be unpredictable, and trying to time them perfectly is tough. Investing now might seem tempting, but if the market takes a dip, your client could end up paying too much. Waiting for a clearer signal might be the safer move, reducing the risk of buying at the top and giving your client a better chance to find a good deal. Question 23. REITs. Are you ready? Your client is thinking about investing in real estate investment trusts, or REITs, as a way to diversify their portfolio. What do you recommend? REITs offer a simple, diversified way to invest in real estate without having to buy physical property. It's like owning a small slice of a big pie. Your client gets exposure to the real estate market without the hassle of managing properties. For most investors, REITs are a good choice, offering the benefits of real estate with less risk than owning individual properties. Question 24. Investing in T-bills, are you ready? Your client wants to invest in treasury bills or T-bills because they're concerned about capital preservation. They ask, should I go for it? T-bills are one of the safest investments out there. It's like putting your money in a vault. The returns might be lower, but they're backed by the government, so there's little risk of losing money. For a client focused on safety and capital preservation, T-bills are a great choice, especially when market conditions are uncertain. Question 25. Target date funds. Are you ready? Your client is unsure whether to invest in a target date fund for their retirement savings. They ask, should I do it? Target date funds are like a set-it-and-forget-it option. As your client gets closer to retirement, the fund automatically adjusts to become more conservative, reducing risk. It's like having a built-in advisor that shifts the balance as needed. If your client doesn't want to worry about constantly rebalancing their portfolio, target date funds can be a smart, low-maintenance choice. Question 26. Dollar cost averaging. Are you ready? Your client is considering using dollar cost averaging for long-term stock investments and asks, is this a good strategy? Dollar cost averaging is like buying groceries every week. Sometimes the price is high, sometimes it's low, but over time it averages out. This strategy helps your client avoid the temptation of trying to time the market, which is notoriously difficult. For long-term investors, dollar cost averaging can reduce the impact of volatility and smooth out the ups and downs of the market. Question 27. High-yield bonds. Are you ready? Your client is thinking about investing in high-yield bonds, also known as junk bonds. They ask, should I do it? High-yield bonds can offer great returns, but they're risky. Think of them like a high-stakes poker game. The companies issuing these bonds might be in financial trouble, and there's a higher chance they could default. Unless your client is comfortable with that level of risk, it's usually better to stick with investment-grade bonds that offer lower returns, but more safety. Question 28. Hedging with options or derivatives. Are you ready? Your client is looking to protect their portfolio from losses and asks, should I use options or derivatives to hedge? Think of options like an insurance policy. They help limit losses if the market takes a turn for the worse. For example, if your client owns a stock, they can buy a put option that allows them to sell the stock at a certain price, protecting them from big drops. For clients concerned about downside risk, options can be a smart tool for hedging. It's like having a backup plan ready, just in case things go wrong. Without this protection, their portfolio could face significant losses, especially in a volatile market. Question 29. Holding cash. During market volatility, are you ready? Your client is worried about market volatility and asks, should I hold more cash or invest it now? Holding cash during volatile times can feel safer, like pulling over when the road gets rough. It's a way to avoid the ups and downs of the market, especially if your client isn't comfortable with risk right now. On the other hand, holding too much cash might mean missing out on growth opportunities when the market rebounds. If your client is concerned about preserving capital, increasing their cash holdings can reduce the risk of losses. But at the same time, you should remind them that staying on the sidelines too long could limit their long-term gains. Question 30. Investing in gold as an inflation hedge. Are you ready? Your client is worried about inflation and wonders, should I invest in gold as a hedge? Gold is often seen as a safe haven during times of inflation. It's like storing value in a vault that doesn't lose its shine, even when everything else is getting more expensive. While stocks or bonds might lose value due to rising prices, gold tends to hold or even increase in value during inflationary periods. If your client is looking to protect against inflation, investing in gold could be a good choice. But remind them that gold can be volatile, so it's important to approach it as part of a balanced strategy.